Hello traders, Gary Wagner here. It is 1 o'clock in Honolulu, 6 o'clock in New York on Friday. Happy Aloha Friday, as we say on the islands. It is the 17th day of January 2025, and this is the evening report for gold and silver. Amid policy uncertainty and rate cut speculation, gold showed mixed performances today, with the most active February contract closing modestly lower and the front-running month February gaining ground. An interesting divergence between the January and February contract of gold futures, all coinciding with dollar strength. The dollar gained 0.45%, taking the index to 109.255. When we look at the front month, which is January gold, although it lost $2.10 today, it did close above its opening price and is currently fixed at $2,744.30, whereas the February contract, which is trading very close at $2,740, actually declined by $6.90 and closed below its opening price. Lastly, spot gold also declined by $11.79, fixing a troy ounce of physical gold at $2,702. Since the dollar began its historic rise from 100 on the dollar index to as high as 110, it has pretty much been on a solid, defined upward trend, except for points in which it traded sideways, in essence consolidating before its next spurt. We see another period of consolidation at the end of December, and for the most part, we have seen a choppy market, although in a defined uptrend, in which it will gain ground, give a little bit back, and then have another spurt upwards. Currently, the dollar found strong resistance right above 110 on the dollar index. That is these wicks that are present a week ago Monday, as well as a week ago Friday. That created these upper wicks, this one occurring on Monday, and this last Friday. Following that, the dollar has been trading under a little bit of pressure, but recouping about 3/4 of the losses in trading today. After falling from the all-time record high above $2,800, we have seen gold prices drop and then try to regain that value. On the last 3 occasions, gold prices stalled right around $2,750. The first time was November 22nd, December 11th, with the most recent instance yesterday, when gold climbed as high as $2,758 and then closed just below that at $2,746. Although today was a fractional decline in February gold, the truth of the story behind trading today are the wicks, and to see that we need to look at an intraday chart. Focusing on the trading activity and price ranges of just today, we can see that gold futures opened at $2,744.50, and over the next few hours would trade to the intraday low today of $2,729.50. However, what followed was a move from $2,730 up to today's high at $2,760. This is where that top comes in at $2,760, settling at $2,740. Considering the close of $2,740 and the open of $2,744, we had tremendous price swings over the last 24 hours, settling with a differential of roughly $4 between the open and closing price. Although today's daily candle was simply a small spinning top, as you saw, the real picture could only be truly seen with an intraday chart. That being said, we are still looking at potential resistance right at around $2,760. However, with the presidential inauguration occurring on Monday, we could see a ramp up over the next couple of weeks of extreme volatility, which is why I want to look at the big picture. Our primary method of calculating upward momentum has been Elliott wave. We have been utilizing a primary wave count, waves 1 through 5 being the motive phase, which is followed by a corrective phase. The two sections combined equals a full wave count. We have completed our first motive wave and correction, our second motive wave and correction, and are currently in a primary count, wave 1 of 5. Above that, in terms of Elliott wave's naming convention, is our cycle count. And on our cycle count, the entire impulse phase, waves 1 through 5, would be a wave 1. The correction would be 2, 3, 4, and we are currently in wave 5 of 5 in terms of our cycle count. Elliott wave developed 3 basic rules to work with projections of both impulse waves moving higher as well as corrective waves moving lower. One of those rules states that wave 5 and wave 1 should be roughly the same size. So to create a forecast as to where I believe the 5th cycle wave will conclude, I measured the distance of wave 1 from 2,000 up to 2,558, in other words, about a $500 plus move. And beginning at the conclusion of the last correction, we extended that, which is why my latest forecast assumes that at the conclusion of this 5th cycle wave, gold will trade as high as $3,100 per ounce. This has been Gary Wagner wishing you, as always, good trading. We will talk to you tomorrow for the next daily update and review. Bye-bye.